Okay, welcome back to another video. The purpose of today's video, I wanted to cover the topic of risk. Now there's the obvious things that you're going to probably have seen plenty of times before. There's plenty of examples out there discussing risk and risk management in terms of Forex trading. But I wanted to cover some other things that aren't usually mentioned that you don't tend to think about. And we'll also cover my personal risk management as well, which has been relatively simple in my current live trading, but in the past where I've adapted my strategies, I've had some different types of risk management techniques as well. So to get straight into it then, risk per trade, pretty obvious one, and I'm sure you're probably aware of it already, but do not risk more than 2% per trade. That's me telling you this, that's a plethora of other people telling you this. Some people you'll hear contrarians say this is rubbish, this is this, that, the other. Just don't do it. Do not risk more than 2% of your entire account per trade. In terms of calculating risk, you need to this is where the importance of backtesting comes into play, because you need to run through your backtesting and work out what risk you're comfortable with. If you're risking 2% per trade, in line with that, your drawdown is going to be bigger. If you're risking 1% per trade, your drawdown is going to be smaller. What are you aiming to achieve at the end of the day? You know, are you going to be trading your own money? If that's the case, then you might be comfortable with a 20% drawdown. I wouldn't recommend it, but you might be. If you're trading other people's money, ideally you want a maximum of 10% drawdown. That's what you want to target. In order to get that 10% drawdown, you might need to either play around with your risk management techniques, or simply just minimize the risk that you're taking per trade in the first place. So to take away from that, just 2% per trade, absolute maximum. 2% per trade. The other important things to take into consideration are maximum risk at a certain point in time. So are you going to have limitations on the amount of trades you've got open? For example, do you want to risk, if you're risking 1% per trade, you might have 5 trades open at one time. So there's 5% of your entire account on the line at one point in time. You cannot breach that 5%. If that's the case, you need to, again, this is where your backtesting comes into play, because you need to have worked out whether it's better to do that or not. So the odds in your favour that, you know, potentially that 5%, you could lose all 5 of those trades and lose that 5%, which is a big hit to take. But your backtesting will show you your drawdown with a maximum drawdown of, say, 10% in your account anyway. And your recovery factor will be X amount times greater than your drawdown. Again, there'll be a separate video on drawdown and recovery factor and all that type of thing anyway, but I have covered these in previous videos. So drawdown is just the percentage loss in the account. So if you take an account from over a given period of time, so if you take an account from, let's just call it 10,000 to 15,000, and then you do not get that account back above 15,000, so it drops to, say, 14,000, you've had a £1,000 drawdown, and the length of time you're in drawdown is until you break back above that 15,000. So if it takes you 10 trades to break back above 15,000, you're in drawdown from the moment you've hit 15,000 to the moment you get back above 15,000. That's drawdown. Recovery factor is how quickly you come out of that drawdown compared to how quickly you went into it. So if it takes you 10 trades, say, to get into a drawdown of 10% or £1,000, whatever it might be, whatever your maximum drawdown is, if it takes you 10 trades to get to your maximum drawdown period and your recovery factor of 2, then it takes you 5 trades to get out of that, because it's twice as quick getting out of drawdown as it is to get in it. Hope that makes sense. So we'll cover that again in a minute. I'll go through my backtesting results towards the end of the video, and I'll show you my drawdown recovery factor. But ideally I want to save that for another video entirely. So yeah, they're the sort of things you need to consider when picking your risk, and how many trades you're going to have open at one time, so how much you're going to risk at any given time. Other things to regard in terms of risk: are you going to risk different percentages on different trades? So perhaps you are trading several different strategies. If that's the case, then you need to combine all these strategies together in one. In terms of the backtesting results, you need to combine the backtesting results of all of these strategies into one single spreadsheet, or whatever you want to call it, and you need to see how these perform in line with each other. Some strategies might be better than others, therefore are you going to risk more on the better performing strategies and less on the worst performing strategies? Obviously you're not going to trade anything that's negative that you're going to lose money on. However, some will perform better than others, so is your risk going to indicate that? That's something I've done in the past. Personally, at the moment I don't now, because I trade it's technically one strategy across 12 pairs, but the patterns vary. But it is the same strategy, the same setup. I'm targeting the same areas and my stop loss in the same areas every time. So it's just the makeup of the patterns vary slightly. So again, there's something for maybe me to consider. Do I need to start having a look at my risk management and changing it again? Over the years, obviously, I've been trading different strategies and adapting my strategy again and again to improve it. And alongside this, I've adapted my risk management techniques. So there's some things to consider. If I jump into the backtesting spreadsheets, then I can show you this. So this is my backtesting spreadsheet. This is combined in date order. So we've got the date down the side here, starting from 2005 all the way up to 2019. The pairs, this is the strategy, this is just what I've called it. It's a custom pattern. Stop loss, profit target. Now I've gone with 100 pips and 100 pips. It's not 100 pips every single time, but depending on the size of the pattern, it's a one-to-one risk to reward. So this might be 30 pips to make 30 pips, it might be 50 pips to make 50 pips, but no matter on the pip size, I'll be risking the same amount per trade, so it doesn't matter. The pips to me don't matter at all. It's one-to-one every single time, so pips doesn't matter. So to simplify things, I've just recorded it as a winner or a loser because it's one-to-one, and therefore I've just used a simple 100 pips. Here we've obviously got risking 0.5%, risking 1%, and risking 2%. Personally, I risk 1% per trade because I'm focused on the drawdown. I want to minimise my drawdown. The best way to do that is risk slightly less. So risking 2%, you can see the gains are significantly better with 2%, however the drawdown is significantly worse. Again, like I said, I want to focus on the drawdown. The gains are still, gains are still brilliant with 1%. I'm not being greedy here. I don't want to suffer a massive drawdown. I'm not willing to risk that huge drawdown for potentially significantly larger returns. I'm not willing to risk that drawdown. So just some basic stats on the side here. Profit factor 1.79. So just the explanation here as well. Win rate, I'm looking at roughly a 65% win rate. Again, depending on the pair, this varies. I think my highest win rate on one of the pairs is the dollar-yen. Dollar-yen pair, I think I'm up to 70%, and then my lowest is about 56%, so averaged out at about 65%. Total trades tested 2,860 since 2005. Recovery factor, again, like I said before, if it takes you 10 trades to get into drawdown and you're out of that drawdown in 5 trades, your recovery factor is going to be 2. My recovery factor is 64. Okay, so whatever it takes me, length of time and obviously amount that I go into my drawdown, I'm expecting to get out of that drawdown 65 times quicker and greater than I went into the drawdown. That's very important to me. Drawdown duration, this is a maximum drawdown duration over the 14 years tested. So maximum drawdown duration is 81 trades. So it's taken me, if I've gone from 10,000 to 8,000, it's taken me 81 long months, 81 trades, which might be equate to like 3 months of trading, where I've not broken back above that 10,000. So I've been in drawdown for 81 trades. However, once I start to get out of that drawdown, the recovery factor is 64 times greater than what I went into it, and that explains itself on the charts here. So like I said here, drawdown duration, I think it was 1000 and no, it must have been then. Yeah, I think this was the drawdown from this point here, and then suddenly shoot out of that up to 21,649, 21,898. So this was, say, 136 trades, so that's 20 trades, and then it's taken us another 8 trades to basically break above that. But you know, that could be, this is based on number of trades, this isn't based on time period. So this here could be 3 months, whereas this small area here could be 1 month. That's not, like I say, it's not based on the time restrictions. So in terms of percentages then, obviously risking 1% per trade. These are all the things you need to consider. This spreadsheet is available on my website to download, so you can input all of this data. All you need to input is this, and it works out everything for you. You can see the calculations at the top here. They're quite complex. So you literally just type everything in to these 3 boxes here, and if you've got profit target 2 and exit 2, then you can type them in as well, and it'll work it out for you in the other, which is somewhere here, yeah, in the other areas here. I obviously don't have target 2, so mine stays exactly the same as it would in target 1. Yeah, so I hope that makes sense. So yeah, I risk 1% per trade because I'm trying to minimise my drawdown. That's something to consider. Up here is from where I was trading my previous strategies. I'd classed my trades from A star to C. So they're all winning strategies. However, A star were my best strategies, A second best, B third best, C were my worst performing strategies, but still profitable. So on my C trades I was risking 0.5% per trade. On my B trades I was risking 1%. On my A trades I was risking 1.5%, and on my A star trades I was risking 2%. Again, this is something you can consider. You know, I'm not really giving anything away for you to, you know, concrete. This is what you should do. This is how you should trade. If you purchase the software, then yeah, I'll give you everything that I use to trade and exactly how I trade. But you know, there's nothing stopping you from creating your own patterns and trading in your own type of way. Again, it's going to vary from individual to individual. So in terms of the win rate, in terms of the drawdown, like I say, if you're trading your own money, then you'll draw down whatever you're comfortable with. You might want to risk 2% per trade. If you can have a look here, so we started 2005, 2006, first trade in 2006. You know, you've got significantly greater gains from risking 2% per trade. Significantly greater gains, but just remember that the drawdown is going to be just as significantly bigger, and that's what I don't want. I'd rather sacrifice the gains to minimize that drawdown. So I hope that makes sense. So in terms of the risk, then that's pretty much everything covered. Like I say, don't risk more than 2% per trade. You can think of this, if you've got the stigma with forex trading is that it's significantly risky. Everyone, you know, your friends, family will probably tell you stay away from it, or they know someone who's lost all their money. That's because they're being idiots, because they weren't sticking to these rules. They weren't sticking to this maximum 2% risk per trade. They're gambling, 100% they're gambling, but they're probably risking, you know, if not all of their money on one trade, then, you know, 10-20% per trade. Something we've seen like that. They think it's a get-rich-quick scheme. It's not. You need to be in this for the long game. It's important you're in this for the long game. So do not risk more than 2% per trade. So if you've got, say, a £10,000 account and you're risking 2% per trade, you're not going to lose that £10,000. Just think of it as, you know, what's that £10,000 going to be doing in the bank? It's going to be earning you maybe 1% a year. Maybe if you've got a good ISA where you literally can't access the money, it's locked away for 3-4 years, while the bank's making 20-30% a year on it, and they'll give you maybe 1%, 2% if you're lucky. What what's the risk? You're not risking £10,000. You're just keeping that £10,000 in a different bank account, your brokerage account. You keep that £10,000 in your brokerage account. You're risking 2% per trade. So every trade you take, you're risking 2% on £10,000. So that's £200. So you're risking £200 per trade. Yes, you've got £10,000 in the account, but you're not risking £10,000. Like here, if I'm risking 1% on a £10,000 account, I'm risking £100 per trade. My maximum drawdown is 11%, and that's only hit it once in 14 years. 11%. So technically, if you want to be, anal about it, technically, I'm risking £1,100 of my money in 14 years. I've got a £10,000 account, but I'm only risking £1,100 of that. If in worst case scenario, technically, if it goes above 11% drawdown, this is why we do this, because I've done this. If my trading goes, if I dip below above 11% drawdown, I'm going to stop trading. I know I've done something wrong because it's deviated from my trading strategy. It's deviated from my plan. Something's not right here. Something's gone wrong. So, say you've got £10,000, you immediately go to 11% drawdown. That's it. Stop. You've risked £1,100. You can take the other £8,900 out and put it back in your bank account. Before you get into this is what you're risking. You're not risking the full £10,000, and that's what people don't seem to understand. Everyone thinks if you've got a massive trading account, you're risking all this money. You're not. You're risking, like I said, depending on the drawdown or depending on whatever you want to base it on, you're risking 1% per trade. You're risking 11% absolute worst case scenario. That's what you need to get your head around. But like I said, main thing to take away: do not risk more than 2% per trade. Potentially, if you're trading different strategies, alter the risk management techniques. Alter that. So alter the risk depending on the strategy and the strategy's performance. Again, it's something to play around with. I don't do this now because I tested doing this on this particular strategy. I tested this between different pairs, and it worked out just as good, just risking 1% per trade. The differences were minimal. Why overcomplicate things? I may as well just keep everything exactly the same, risk 1% per trade, and rather than going through all of this every single trade, working out which one's which and what I'm going to risk. I say the differences were so minute that I may as well just risk 1% on every trade. And my trades, I'd like to think, are such a high performing strategy that I don't need to worry about this too much. In terms of maybe maximizing profits, if that's what you're into. Mine was, I know I'm going to make profits. Mine was minimizing my drawdown. That was my main intention. So yeah, there's food for thought there. If there's any questions or you need help with anything, like I said, this is available on my website, this spreadsheet. So go and download that, have a play about with it, do your own testing. Again, anything I haven't covered here, drop me a message, let me know. Again, hopefully this was useful to you, and thanks for watching. Cheers.